Hello, and welcome to another episode of Frugal Finance. Today we're just going to give a quick roundup of the portfolio. Obviously, it's been a bit of a poor week in the stock market, as you'll probably no doubt have seen in the newspapers and various reports. And we'll have a quick touch on that as to why that is. But before we do that, if you could just smash the like button down below. It's a little thumb. If you could just give that a tap, turn it blue. That really does help the video get out to other people, and hopefully they'll find this video interesting and share their comments below and so on, and that will help the channel grow as well, and obviously we can get more people involved in the world of investing or understanding. There are other videos on how to actually be frugal and how to budget and how to save money. There's videos on property and various other things, so not just the stock market, if you want to check out the playlists. So with that said, please do not forget to smash the like button and subscribe to the channel. And with that said, let's just get stuck in. So, as you probably no doubt seen, the stock market this week has taken a bit of a hit. Pretty much most of the portfolio was in the red for most of the week, but actually there's been some small returns on things. So, as a generalisation, mostly in the red and relatively heavily, leading to a 2.89% loss on the portfolio, bearing in mind it was just shy of 4% last week in the plus, so that's a reasonably big swing. Some of the main fallers are people like Apple are down 10%. We've got semi-large holding with them, and then some of the other companies in here, you'll see PepsiCo down 8%, Penn & Group down 8.7%. And then even I actually sold Cineworld when it kind of peaked at its trough of around about £1 a share. So I made a hefty profit on that one. Then I reinvested the money into Nvidia and PayPal here. You see are both down 7 and 6.7 and basically 7% on both of those. And then also I got some in Square, which is actually down a eye-watering 15% since I purchased it. So obviously what I've done is effectively deleted my losses, my gains even, from Cineworld Group within a short period of time, and put them into net neutral now. Tesla down a total of 25%. Obviously, there's only loose change in there, £8.57, but still down 25% nonetheless. As an overall, the portfolio is looking a little sad in places. Is probably the crux of it. The pie that I've got, as I did a midweek update, is only down 1.75%. That's fared a little bit better, and that is mainly because the risk is spread across 50 particular stocks. So it's actually almost like having an ETF, really, in that sense. And I did receive some dividend payments this week from them. So you'll see here, I think we received this Prospect Capital 5p, and then Stag Industrial 2p, so nothing significant, but overall dividends still standing at £2.50 since December when I first started this portfolio. And then just nip on over to the invest part of the app where we've got Neo. That obviously is also looking rather sad. In fact, that's horrendously down at 18.76%. Good buying opportunity for them, as it has fallen below the $50 mark. Sort of my kind of buy aim is around 45, so that is pretty good. I did buy some more of that in the week because I didn't think it was going to fall quite that low, so that's a shame. But you buy through the dips and through the ups. That's what dollar cost averaging is about. So I do plan to buy some more of that whilst it's effectively on sale. So some people have been asking why is it that the market is suddenly crashing. Now, basically, I'm not an expert on these particular things, and I'm sure someone will want to comment below if they know more information on it. But effectively, I'm assuming everyone understands what bonds are, sort of government-backed guarantees, essentially, and the return on bonds started to increase, and normally that's a sign that the equity market, which is what stocks and shares are, is not going to perform as well if the bond market starts increasing, because people start putting money into it and the bond returns are better. And if they're better than, or percentage wise better than the equity market, then people tend to try and switch over to them because obviously they're a lot more secure. And the bond return got above 1.6% or points in America, which basically is quite a big swing from 1.5 to 1.6. And that basically made a whole load of people pull their money out of the equity market and start putting in the bonds as a protection against inflation and future downturns. So that is effectively what has happened, because you see that some of the UK stocks haven't suffered quite so bad in places, but as a generalisation, that is basically why the stock market or the equity market had take a bit of a turn. It did actually get considerably lower than this in the week. I think it was down as little as or as much as -5% on the portfolio as a whole. And it is obviously slightly recovered from that, but not in a full sense. So as I said before, you have to look at this as either a glass half full or glass half empty kind of approach, in that, if you can stay in the market and buy the dip, so put more money into it now, when these things recover, then obviously you'll be making significant profits out of them. Like, for argument's sake, Apple here is down 10% this week, and historically it's performed pretty well, so it's likely that it will recover from that at some point. And you can see here that there have been dips in the past, around here where we've got kind of the kind of end of 2008, beginning of 2019 dip here. There's another little mini dip around April 19, and then you've got the virus dip here. But it is never really once returned back to where the previous levels were. So if you take here, when the dip in 2016, it's never then returned back to that. And then if you take the dip here in 2018 at $39, never returned back to that. Even this dip here only got to $43. So then you go right back up to here and you think to yourself, well, okay, at the height of the pandemic, it got to $60. Which obviously, is nowhere near this 37 that we were talking about, effectively 2 years prior to the dip. So it reinforces the fact that really with your stocks, you should be looking to hold them long term. Obviously, some you might want to trade a little bit, like I've done with Cineworld. It's not a company that I overly believe in long term, and I wanted to capitalise my gains in that and put them into some other stocks, which I do believe in, like things like PayPal, as I've said. I think that will become more and more used and part of our everyday lives as we go forward. So that's the portfolio update. In terms of credits to it, I haven't really put an awful lot in this week, if I'm honest. I put some into Neo. So currently the portfolio is sitting at just over 2,140, plus obviously the holding with Neo, so just so I have £3,000 when you add all of that together. I actually have had an offer accepted on a buy-to-let property, so at the moment, whilst it's a brilliant time to buy in, I am looking to try and scrabble together as many pennies as I can to see that over the line. Hopefully they extend the stamp duty. If you want to know more about stamp duty, I did a video on that yesterday, so please feel free to select that out. Obviously, as I say, any other spare change that I have that isn't part of that, I will plan to buy these in the dips. I even bought some into CCIV, which I know crashed a little bit after the announcement of merging with Lucid Motors. But I'm lucky in the sense, or somewhat lucky in the sense, that I've bought it obviously at its crashed price, so I actually have a small return on that, whereas a lot of people would have bought it back here when it was about $60. And a shout out to Let's Talk Stocks, because I understand that obviously they've done a merger with Lucid Motors, so at some point in Q2, quarter two, which runs from beginning of April to the end of June. This ticker symbol, CCIV, will be changing to Lucid Motors or LCID or something along those lines. So anyway, that is the update for the week. So if you enjoyed this, please do give it a bit of love and smash that like button. Just turn it blue. If you do like this and you want to see more videos like this, or check out any of the other videos, feel free to subscribe. That does help the channel grow. And if you would like to start your investing journey, please do use the link in the description below, where you can get a free share valued up to £100 with Trading 212, or if you use Freetrade, the other app, you can get up to £200 with that one. I've also done videos on which one I think is better personally for different scenarios, so please do check those out. So with that said, please remember that these are financial entertainment style videos. I am just a guy on YouTube. Shouldn't take anything that I give you as advice. Please don't copy my portfolio thinking that you're gonna do as well as I have. Not that this is obviously looking that great at the moment. Please do take your own financial advice and make your own decisions. This video is not advice. They are just for entertainment purposes only. So with that said, please do not forget to smash the like button, subscribe to the channel, and I shall see you next time.